So inside the spread chain, I know I want to do a bull put on SPY, so I want to compare it to the bull call debit. Now, when we look at any expiration that's within the next 5 weeks, it's going to be considered a weekly option. Yes, the June 16th series, of course, is a standard expiration, but it's 2 weeks out in time, or 14 days out in time, so it's considered a weekly now. You know, we can go down the list of all the available expirations, and as I mentioned, it gets a little bit confusing now because we do have the Monday series the Monday series on June 7th, and the Wednesday series, and then the Friday, and then the next Friday on the 16th, and so on and so forth. Okay, so that adds a little bit of confusion. But if I know I just want to go 14 days out, well, I know that the spread differences for SPY are going to be 50-cent spread differences. In addition to adding weeklies, which wasn't too confusing at first, but then stocks that started offering weekly options on the weekly series, they had dollar-point strike differences where the standard expiration, maybe 35 or 40 days out, only had 2 points or 2.5 points or 5-point expirations. Well, then they complicated it more by adding 50-cent strike differences. So you get a lower risk factor because you can trade with only 50-cent strike differences, but at the same time, you're getting a smaller net credit. Your percentage might look really great, but you might be getting 2 cents on a 50-cent net credit for a 7-day trade. That might work out for you long term, but you got to trade a lot of contracts. In any case, here's what we're going to do in the spread chain. I'm going to do a bull put on SPY. I'm going to keep my spread width at 2 points. We could set this to 5. We could set it to 3. We could set it to 50 cents if we wanted to, but I'm going to keep mine at a 2 strike spread width. Minimum net credit, I want to get at least 25 cents of net credit for my spread. Range out of the money, the short put or the short call if you're looking at the bear call credits, for example. Well, I'm just going to keep this at 1, but I'm going to up my percentage return to at least 11%. And at the same time, I'm going to leave my probability at 70 for now. But rather than looking at June 21st, I want to submit this for June 16th. Okay? So, what are we looking at now? We're looking at 3 possible spreads that match our criteria of having at least a 70% probability 14 days out in time on SPY. Now, most of these are going to be further than 1% out of the money, but you see a lot of them are close. With SPY trading at, I'm going to put it up here, 244.17, we see that the first spread is the 239.5 to 241.5. That's only 1.1% out of the money for a 14-day trade, but it does come with a 75% probability, and we're looking at a potential return of 22%. We have a net credit of 36 cents on the position. Okay, so this is a little bit better than the search by symbol because we've narrowed it down to the 3 spreads that offer the probability that we want and at the same time offer the net credit that we want as well. Remember when we looked at the search by symbol, we saw 60% probabilities and 68% probabilities that came with credits of 45 cents, 42 cents, and so forth. Well, the credit sounds great, but the probability doesn't. We're about 0.5% out of the money. We want a little bit more cushion. We're not seeing the positions that have that 90 or 95% probability because we had a requirement of a 25-cent net credit. Those exist, those spreads with a higher probability, but they didn't match our other criteria. So we've narrowed it down to just the 3 or 4 bull put spreads that have the credit that we want, the return that we want, and the probability range out of the money. Now why do I want to look at this tab here that has the put credit and call debit parity? Because if I've decided that I'm going to do a bullish spread, I want to compare it to the parity trade on the position. Because I might get more bang for the buck on the bull call debit side. So let's take the standard non-50-cent strike differences here for our bull put credit spread. The 239, 241 bull put spread, where we'd be selling a 241 put on SPY, currently and again at 244.17, and we'd buy the 239 put. Of course, as long as the stock stays above 241, both puts expire worthless, we keep our net credit. Our max risk is realized if the stock stays below 239. Here, we see our midpoint prices, another advantage of the spread chain, where we could sell the 241 for 80 cents, buy the 239 for 49. We'd get a 31-cent net credit or an 18.3% return for 14 days if everything works out as we expected. Now over here on the left, what I'm looking at is the bull call debit position, which is the parity trade to the bull put credit. Has the exact same risk reward profile, but here I'm going to sell a 241 call for about 374. And I'm going to buy a deeper in the money 239 call now for 556. Now this gives me a debit on my 2-point spread of 182. That's what I'd have to pay to enter the position. So if the stock stays above 241, I'll essentially buy shares of stock at 239, sell them at 241 and get $2 back. Well, that's only going to give me 18 cents in net credit, or a 9.9% return. The probability is exactly the same, because all we're looking at is the likelihood of the stock staying above 241. So in this case, the debit spreads are not a better return than the credit spread, so I'm going to stick over here with a credit spread position for SPY if I was bullish and thought the stock was going to stay above 241 in the next 14 days. Okay? But other times, you may see that where you've decided to do a bull put credit, you might see a 10% return here for the bull put, and you might see a 14% return here if you get midpoint on the bull call debit. In that case, it might be worth your money to do the debit spread over the credit. And that's what this parity view shows you when we're in the spread chain tool, which you can access underneath the vertical spreads or underneath the signature tools tab as well. And of course, as I mentioned, you could set these levels any way you want. If I just want to do 5-point spreads, I want to up this to 45-cent net credit with still a 70% probability. I'll take my return down to 9. Let's see if we get anything. There we go. So now I've got the 241, 236. Of course, still at that same probability that we were looking at before, above 70 at least, and our net credit of 54 cents, still double the debit spread. Oh, Tom asks, isn't the credit spread always better than the debit spread? Percentage return-wise, no. Okay, in this case, yes. All right, in this case, what we're seeing on SPY is that the out-of-the-money bull puts are giving us a better credit at midpoint than the debit for the in-the-money bull calls. Is one really better than the other? Well, it depends on what you're trading. I'm sorry, let me rephrase that. It depends on how many strikes you're trading, how many contracts, I should say, you're trading on the position and what your goals are. What do I mean by that? See, if I did a bull put credit spread right now on SPY using a 236, 241, okay, we have the same profit and loss chart. I'd pay one commission, one spread commission, which might be a commission and a half, to enter the bull put, selling our 241 and buying the 236. We get a credit up front, and then we'd have to put the 2 points on hold in our account, or 2 points minus the net credit, or in this case it's 5 points. I apologize. We're at the 5 points. It's 236. Sorry. So in this case, you have to have the 5 points on hold in your account to cover the risk obligation. So you still have, with a 54-cent net credit, you'd have $4.46 on hold in your account until the trade is closed or you hit expiration. If the stock stays above 241 with the bull put, both options expire worthless. You don't have to do anything. You keep the net credit of 54 cents. So there's your 12.1% return. Didn't have to do anything else. Your broker might charge you a small fee for expiring options. Depends on the broker, of course. You don't have to do anything else. When I enter a bull call debit, I've got the same risk-reward profile. because the max return is above 241 and the max loss is below 236. In this case, we paid a debit of 469 to enter the position. But we still have to do a spread to enter, so we'll get that 1.5 commissions for entering the spread. But now, in order to close the transaction, if the stock's trading above 241 and I do nothing, meaning I hold it all the way to expiration, let's say SPY stays at goes up to 245 on, in this case, June 14th or June 16th. I'm sorry, June 16th. Now, what my broker is going to do is I have two calls that are in the money. I have an obligation to deliver stock I don't own, or the shares of the ETF. But I have the right to buy them at 236. So Saturday at options reconciliation, my broker essentially buys 100 shares of stock for me at 236, sells them at 241. I get the 5-point difference, so we have a 31-cent profit of our 469 investment. We already talked about how this was a lower return and we might not do this. Okay? But that might be 2 stock commissions depending on how your broker handles it. And of course, as you got closer to expiration, you could close the bull call debit spread yourself. Buy to close the 241, sell to close the 236. You'd get close to the 5-point intrinsic value of the position, of the spread, excuse me. And you're close to the max profit. But then you had to pay another 2 commissions. So debit spread usually requires more commissions. Some brokers might not charge that much for closing an in-the-money debit spread if they know more about what they're doing as well. So that's where you run into those kind of positions. Sam commented in and says, amazing run on SPY, bull run, still intact. He says short sellers are going to get crushed. So it's Sam's opinion that the bullish spreads might still be a good idea on SPY right now, that there's it hasn't leveled out, of course, and it might not be a retracement. Okay, so that's a possibility. You know, I'm not giving this as direct advice on a spread you should trade. I'm just showing the tools and how you could use them. Sam knows that. We always talk about that as well. Excuse me, I've been waiting for a top for a few months now, thinking there was going to be a pullback. We just haven't seen it yet. As I mentioned at the beginning of the presentation, we saw some good market movement yesterday. Of course, let's go back to the main home tab there. Okay, we've seen some good market movement yesterday due to the earnings. I'm sorry, not the earnings, the jobs report, and then, of course, the announcement. Business reacted favorably. Most businesses reacted favorably. I should say some. We'll say most. Most businesses reacted favorably, of course, the announcement of the Paris Pact. And at the same time, you know, there's another report coming out by the Fed today. I actually didn't see it as well. What we see here, we're kind of in a neutral sentiment right now based on our market sentiment. It hasn't updated yet. It'll probably update for June 2nd in about 8 minutes. And what this is a listing. The market sentiment tool is a sort of range, a gauge, based on 13 broad-based indicators that we tested and back-tested over time. Ernie did a lot of back-testing here on indicators that when they hit a certain range, when we saw a market collapse, let's say over the last 6 or 7 years, a market change, what indicators really perform that? Now we see here that the put-call volume ratio right now is in a bearish mode. So this is a total number of puts divided by the total number of calls volume-wise over the entire market. And right now we see that we're at 0.58, which means we have a lot more calls than we have puts. Okay, so the ratio of put volume divided by call volume is only at 0.58. If it's 1, it's even. If it's greater than 1, there's more puts and so forth. Okay. Now, what Ernie saw is over the past 6 years, this particular indicator, when the put-call volume ratio was below 0.6, we reach here. What this is a histogram, I'm sorry, of the occurrences of these values. But here we are at 0.6. We see it infrequently goes lower than that with a put-call volume ratio. And so we set a fence, at 0.6. And what we notice is around 0.98, 1, or 0.9, you don't see a lot of occurrences over time where it goes much above that. And of course, you can see at the last market high, you know, the real market high before a real pullback was on September 19th, 2013, it was at 0.56. Okay, so we're in that 11th percentile of the range there. So this is actually went bearish because normally we don't see it go further. We don't see this ratio go much further below 0.58. What we also discovered is that in general, it's okay to have a bearish indicator. We see other things. The VIX, of course, is bearish. I had a really good return 2 weeks ago. Well, I closed it last week, but 2-3 weeks before that, I bought calls on the VIX when it was at about 10.10. We had that little hiccup last week where it moved up to about 14 or 15. So I had a 68% return on just the calls I bought on the VIX for that few days trade. But, you know, rarely, let's look at the details once more. Here we're down at about 9.89. It's usually bearish when the VIX is below about 15 or 12 at the last market high. You know, it's been different because we've been stuck at, what, 10 and 11, really between 10 and 11, off and on for the past 2 months there. Okay, but there's various indicators. We do have a bullish indicator, the TRIN. The 10-day EMA is actually bullish right now. But you can see each of these in that market sentiment tool, and you can also look at the sentiment history going back a little bit there, the last time when a bearish sell was triggered. So this is just one of the tools that we use, and there's a video here actually on this tool that describes how I use it for my own trading. If I see a sell warning, well, if I've got, let's say, a collar spread open where the stock's been touching the short call or moving a little bit above it, and I see a sell warning or a bearish sell warning, I'll leave that alone, because if it pulls back, that call is going to work out better for me. If I have long call positions and I see a sell warning, I might sell a call at that point against it in a calendar format or a spread format, because if it does pull back, I'll be able to hedge some of the loss that I've taken that I don't have locked in right now in the long call. Or I might buy a put to lock in some of the gains. That's all available in that help video there under the market sentiment indicators. There's 13 broad-based indicators. We talked about the VIX, stocks hitting a new 52-week high and low. That just jumped into bearish mode. The number of stocks over their SMA 20, the number of days the SPX has been up, for example. Those are some of the indicators that we found. And once you get a trigger, maybe 5 bearish indicators compared to no bullish, it'll change to a sell warning or a bearish sell warning. So in the next few days, you might see a pullback. Oh, sorry, I didn't want to do that. Just going to try to refresh the page real quick. Let's see if we loaded the history yet. Nope. Okay, so it'll be in a couple minutes. All right. John asked, is John? Oh, it's John. Yeah, okay. Just the 3 letters, J-O-N, John. John asks, do you support horizontal spreads? Yes, we do. Calendar spreads, horizontal spreads at the same strike, you can access in our calendar call or calendar put spread position. So when we go to calendar calls, of course, you see a profit and loss chart here that is reflective more of a diagonal call spread. And what does that mean? That means if I'm building a position right now, we'll just take SPY, because we just saw where it was at 244. With a diagonal spread, I might sell a June 245 call, and at the same time I might buy a September or October, maybe even just an August, but further out in time, 240 or maybe a 235 call, so that we have an in-the-money call, we're selling an at or slightly out of the money, and that gives us the diagonal profit and loss chart. This is our sell and this is our buy further out. Well, many investors like to do what's called the horizontal. Some refer to it just as a calendar spread, but it's a horizontal where it's more of your tent profit and loss chart where I'm selling the 245 June, but I'm also buying the August or September 245. So I'm at the same strike spread, so it's more of a horizontal spread as opposed to a diagonal. And of course in PowerOptions, if you go into the search, I've got various default criteria stuff. We have criteria set for every one. Default criteria for you to use as a stepping stone in every one of the 23 strategies. So if I just go to calendar leaps number 1, ignoring the results, let's scroll down below the list of trades. You see that this particular one is looking for the next full expiration out to July against all leaps, with criteria such as limiting the net debit on the diagonal spread to be less than 15 points, max return of at least 5, and we're wanting, in this case, we've set it up so where the delta ratio is greater than 1.8, which means that the long delta, the delta of the buy option has to be higher than the delta of the short. We're forcing it to be different strikes. The long call is in the money. The one that we're buying is in the money or lower than the call that we're selling. And I can customize this. I could just look to June and let's try it. Let's go to June to September. 15 days versus 105. See if anything else matches. Okay, then we've got some for Finisar, Goldman Sachs, JP Morgan, with a short call here, the June 84 on JP Morgan with a stock at about 82.64 and buying it in the money September 80. Okay, but in our default criteria, John, there's another one here called same strike spreads. It's a horizontal, and here we have a horizontal search that's personal that I created during a webinar a few weeks ago. But if we go to same strike spreads, now we're looking at positions that we still might be selling a July and buying a leap. It's keeping that for the basics, but you know, it's the 77.5 to 77.5, which gives us that A profit and loss chart. But if you want to shorten the time for the horizontal spreads, use this default search as a stepping stone, just as we did before. Change it to June and September. All right, and so now we see positions, same strike, but we're selling a June 14 days out and buying a September. I don't like this one because the stock's at 69.52, so it did sort of a bearish bias. It did the 65s. I probably prefer to do the 70s. So going through this list, I feel most of these are kind of at the money, but some of them are slightly in the money. Might not be a bad profit and loss chart. Let's take a look at Royal Canada here, our same strike spread. Through the More Information button, we'll go to the profit and loss chart. And yeah, it's offering a good return. Break-evens are about 7 points apart for the position, but remember it's a 65 and we're already at 69 in the loss zone. So I don't like that. I want to isolate this search to find me positions that are right at the strike price, okay, right at the money. So I can do that using our percent in the money and percent out of the money ranges for the short option or for the long option. So for the in the money near call, the one we're selling, I'm going to restrict the range in the money, let's say to be blank to 3. And I'm going to restrict the range out of the money also to be blank to 3. So that means I'm not allowed to go more than 3% in the money or 3% out of the money on the stocks that match the other criteria. It still has to match my spread conditions. And there we go. So now we see Thor at 93.64, June 95, September 95. That's pretty good. Finisar is at 25.50, right between two strikes. We do see the 26 and the 25, both within 3%. So you could set a bullish or bearish bias in that case as well. So we do support the horizontal spreads, as you asked, John. Go into the calendar call or calendar put, depending on your sentiment, and then just start off with that same strike spread default. You'll be able to see the criteria over here on the right-hand side. Anytime you open any search, you'll be able to see the active search criteria over here on the right-hand side. So you can make tweaks to that based on your requirements for net debit, time frame, range in or out of the money, minimum bid, minimum debit, and what other stock criteria you want to put in as well for your particular spread if you want to look for a more neutral position or if you want to look for a biased bullish position or biased bearish position as well. All right. Okay, so I don't see, let's see there. Yeah, it looks like I've, we're only at 5:07, but I have answered all the questions that have come in. So if anyone has any other questions that you want to send our way, just let us know. One of the other pods we have available is the top stock gainers. Okay, and top stock losers. I'm just looking at this one right here because this one here, RH, the hardware restoration, had a great trade with that today. It was a 3-day straddle position. The stock's down at 42.54. I actually did the 55 call and put that expired this week for a cost of about $5.50 for both the call and the put, and of course was able to close out of this 55 put for around $13 inter trading. So it was a nice 120% return there on that particular position. I didn't do these ones here, but I also had a short straddle, or I'm sorry, a long straddle, a buy straddle today on Lulu, L-U-L-U. So it moved up, I want to say about 15% at the open and closed about 12% up or so. So that was a reasonable 78% return for the straddles. Very expensive to get into, but of course you got to get that movement greater than 9% and you'll have a winning position, greater than 10%. It's one of those things that you can check there. Of course, you can always check stocks that have earnings coming up. I didn't have GOOSS or A&W, actually, but that's a small mover. It's a small price stock. That's why. I didn't have CKH. And that just took a complete dive today at 40%. So that was a really bad earnings, I guess, on that position. Yeah, remember when you're playing earnings, someone asked what's the, Jim. Jim asked what's the difference between a long straddle that you said and a short straddle. Do you mean you're going further out in time? No. A long straddle or strangle applies that you're buying the call and the put to sort of get your V or your U profit and loss chart, which is great for earnings because you don't know what's going to happen. You're expecting a movement one direction and the other. The short straddle or short strangle means that you're selling, okay, which you don't want to do in earnings because you can get hurt even though you're getting a lot of premium. Okay, so in a long strangle here, when RH, for example, was at 57 at yesterday's trading, to do a long strangle, I'm going to buy an out-of-the-money call and an out-of-the-money put. All right, so I might have bought the 60 strike call and bought the 55 put. And of course, with the reason why is I want to profit if the stock collapses or profit if it moves up. By going out of the money, you pay a lower cost basis, a lower debit, but you have a wider range to break even. Because not only do you have to cover the debit, which you do in the long straddle too, which is more expensive, but now you've got to cover the movement to the strike. So if I only paid $2 here for the strangle, and I mean $2, $1 for the call and $1 for the put, for example, I need it to move up to 62 or down to 58 to make a profit. Down to 53 to make a profit. We're sitting here at 57, okay? So it would need to drop below the strike and then the debit, so you get a wider up and down movement on the position. Now, with a straddle, a long straddle, you're buying right at the money. So with a stock at 57, you might have bought the 57.5 call and the 57.5 put, and you might have paid $4, okay? But now the break-evens are a little bit lower because you're at the current strike price. You only need this to be trading at 53.50 or 61.50. Now, I know the example I gave you is only a 50-cent difference. Sometimes it's a little bit better depending on the prices. Sometimes it's not. But that's the idea. You get a higher cost, but a lower upper and lower break-even with these straddles. Strangles have a wider upper to lower break-even, but a lower cost. But if I did a short straddle at earnings, okay, that means you're selling the call and the put. They're both naked. And you might have collected $4 in premium, okay? So now you say, oh, well, I have a good cushion, a break-even down to 53 and up to 61. Okay, so I'm not going to lose money unless there's that big of a movement. Well, we saw what happened in this case. It dropped down to 44. So with a 53 break-even, you're down at a loss of $11. You only collected 4 to begin with. So that's about a 300% loss on the position. So yeah, you don't want to be doing short positions or short strangles unless you're really, really far out of the money. And in that case, you're not getting a lot of premium. So when you're doing earnings plays, you typically want to stay with the long. Yes, there's going to be implied volatility crush. Yes, you're expecting to lose 100% on one of the legs, but you're doing it with the expectation of a large move. So in this case of RH fell, I was okay giving up 100% loss on the call because I had a 400% gain on the put. Okay, well, it was actually a straddle, I should say. So that's perfectly fine. That's more than fine. Actually, it's about a 600% gain on the put. In any case, all right. Let's see here. Got some questions coming in. There's a long one. Let's see here. Sam mentioned special dividend still holding cost. Was that the same? I'm sorry. I think I just got confused here on the comments. I think I got a wrong. Yeah, I did. I'm sorry. Okay, 1 second here. Reading into two different things. My apologies. Okay, Patrick says, I was paper trading the following. All right, let's go back to our default view here for our default strategies. I want to go to custom spreads. This is where we can build a position on the fly. I'm sorry, Patrick says paper trading. I entered a long trade on 800 shares. Oops. Of OKE. Okay, at 37.73. All right, and then on 5/3, you bought 8 June, expiring today, 53 puts. Excuse me, so he paid 37.73. The stock must have moved up. He bought 8 53 puts. Okay, so let me do that. I'm just gonna put in a price here. 8 at, it's still in the money at this point. Then let's just put in, I don't know, $2. Okay, so here's a short-term married put. He locked in gain. I used an example of $2. Maybe it was higher. It's $2.50 or so. But anyway, let's just keep the numbers simple. We'll do 1 and 1, unless you do a ratio somewhere in here, and I'll check that out. Okay. So here is the position, locked in profit of 33.4% based on my cost basis of 2 that I just created. I don't know what his actual cost was. So anyway, on May 4th, suggested trade was sell to open the June 49.50 calls at 141 and buy 8.51 calls at 79. Okay, so now at this point, okay, so as he's tracking the trade, he saw what's called a bear call spread, income method number 6, to create a spread on the position. So we'd sold 250, sold to? Yeah, sold to open 249.50 calls and bought to open 51 calls. And we're at 141 and 79. So we sold the at the monies for 141 and we bought the out of the monies for 79. Okay. Let's go ahead and submit that. All right, the stock closed today at 49.55. Here's your position. Got a little hiccup on the spread. Okay. Okay, and he says, what happens to each side of the trade? I can't get my mind around all these obligations if I were to do this kind of trade in the future. Okay, here's the tricky part, and you would have wanted to manage this position. Number one, this is one of the reasons why I never do this. This isn't a bad trade, don't get me wrong. Okay, and the stock traded right here, just above 49.50 on your position. Okay, we had a protected position. We added a bear call credit spread by selling the 49.50 and buying the 53, and so this gives us that profit and loss chart with a little check mark. Okay, but here is the problem, and I understand the situation, how it can be confusing. This is one of the reasons why I don't like ever selling a call below the put strike price in any adjustment or strategy. Okay, so I'm close. I put in 2 and you were at 190 for the puts. Thank you for saying that. But here's why. You have, I know, I put in 100, but you have 800. Okay, so you have 800 shares of stock, 8 puts, 8 calls. Okay, no matter how you look at this position, because the stock is between, yes, you have a long call at 51 as well, right? Okay, but that's irrelevant. That one expired worthless. Now you've got a short call that's in the money. Yes, it's only 5 cents in the money, but it's still in the money. And you've got a 53 put that's also in the money. So you've got 2 obligations. What are your 2 obligations? The stock's trading below 53. Okay, so you have the right to sell your shares of stock at $53. But here, you also have an obligation to deliver shares of stock 800. Both of these are 800 representations, okay? So here you also have the obligation to deliver shares of stock to someone at $49.50. Here's what I'd expect to see at your broker on Monday morning. You're going to see a notification that you were assigned on your $49.50 call, because you have to cover that obligation of the $49.50 call. You entered an obligation to deliver shares of stock, so your 800 shares are going to be assigned $49.50. So you still had a call space at $37.73, you get out at $49.50. Decent return. Now there's another problem. That takes out the call. Your 51 already expired, worthless. It's out of the money. Your short call is assigned on your 800 shares of stock. Now you've got an in-the-money put, a 53 strike in-the-money put. You didn't close it. You didn't close the short call, but you didn't close this either. Okay, you can't cover two obligations, two 8-contract obligations with only 800 shares of stock. You need 1,600 in this case. If you had 1,600 shares, half of them would be sold at 53, the other half would be sold at $49.50. So in this case, what's going to happen? Well, your broker covered your short call obligation with the stock most likely, but you've got an in-the-money put that you didn't close, so your broker is going to assume that you wanted to exercise it. Well, you don't own the stock anymore to deliver essentially at 53, to sell to someone, to force someone to buy from you at 53. So come Monday morning, you're going to be short 800 shares of stock at $53 per share. You're going to get 40,000 some odd, $42,400 deposited in your account. But if you can't be short stock in your account, your broker's immediately going to buy 800 shares at market price for you. And if the stock moves up to 50.10, okay, you essentially gave up 55 cents of profit. Okay, I mean, that just means that the stock moved up. You're now short stock, so you want it to continue to fall. But if it fell to $48 on Monday's open, well, fantastic. You got an additional $1.55. Okay, so this is okay. Now hold on a second here. I'm just going to follow this up. Anyway, Sam's question there, and there's Patrick's. Okay. Okay, so in this case, when you have a put here, bought put here, and a short call here, and your stock ends right between it, you have an obligation to deliver here, and your broker will most likely take the stock to deliver the call, but now you've got an in-the-money put, and if you don't close the in-the-money put, and the stock was taken away from you for another transaction, you'll be short shares of stock at the put strike price. There you go. And that's why I don't like selling calls below the put strike price, especially when I have the same expiration date. Now, if this was the 16th of June put, it's not a concern. Okay? On Monday, this would expire. You would have been assigned at $49.50 for the June 2nd, and you have 14 days on the 53 put. We would just sell to close it. But because you held it to expiration, the put, if you don't close it, your broker is going to force someone to buy shares of stock from you at 53, which you don't own, so you're going to end up being short shares of stock at 5,300. I'm sorry, 53 strike, and you've been assigned here, so that's why you're short. Okay, so that's what would have happened. Short call, if you're long stock, short a call, and long a put, but the put's higher than the short call and the stock ends between the strike prices, either way you're going to end up being short stock. What do I mean by either way? Well, let's say your broker exercised your 53 put to deliver the stock you want, as you wanted, and so you get out at 5,300 on your 100 shares. Now you're sitting on a $49.50 naked call that you let expire in the money. Yes, it's only 5 cents, but the rules for the Options Clearing Council are if it's 1 cent in the money, it's going to be closed out to, stimulate assignment and expiration, which is what most people want. So what does having a short call at $49.50 mean? It means you have an obligation to deliver shares of stock you don't own now at $49.50. Those 800 shares were taken away by the put obligation, so you are short stock at $49.50. It doesn't matter which way your broker does it, essentially. If you're short shares of stock at 53 or short at 49.50, I say that, independent of what happens on Monday morning's open, the monetary amount will be the same. Either you're short shares of stock at 53 that's trading at 49.55, so there's, that's a $3.45 gain, and you got assigned at 49.50, or you got taken out of the stock at 53 for a 16-point profit, but now you're short shares of stock right at the money at 49.50. The monetary value would be exactly the same. You'd be right here. Doesn't matter how your broker handles it. Remember, the 51 call is disappearing. The only time your broker could use the 51 call is if the stock was trading, of course, above 51. All right, so that's what ends up happening in this position. If you have two obligations to essentially do the same thing, a short call and a long put, and the stock ends between the strike prices, you have a double obligation. If you're short a put, let's say at 49.50, and I'm sorry. Yeah, if you're, short a put at 53 and long a call at 49.50, and it end there, you would end up owning 1,600 shares of stock. 800 at 53, 800 at 49.5. Okay, so that's where that goes. All right, so that is a tricky one. You're absolutely right. Don't get me wrong, Patrick. That's a tricky one because it ended between the strike prices on the position, and your shares would be taken out at one point, and then the other shares would be taken out at the other, okay? Patrick, your comment says, thanks, the price changed near the close at the 49.55, so I should have moved the put earlier in the day. I don't know if you should have moved the put. I might have moved the call. I might have bought to close the 49.5 call once it got in the money in this case. So if the stock continued to go up, well, I still get out at 53, it doesn't matter. But if I get out of the put at that point, you're right. Okay, so the stock, let's say the stock opened at 49, my apologies, Patrick, and your 53 put would have been worth $4. So you could have sold to close the put at $4. Now that's great as long as the stock moved up. But if you sold to close the put and then the stock moved down, now both calls expire worthless and you're holding a stock here, you haven't sold it yet, you'd have to sell it on Monday. Okay, in this case, you're right. If you knew it was going to be above 49, which we didn't, and earlier in the day it was below 49, yeah, selling to close the put to get the most value for it, $4, $4.10, might have been better than getting $3.45 or $3.50 for it here. But at the same time, remember what's hindering the upside here. When I look at this profit and loss chart, what's hindering the upside, what's causing this to lose as the stock moves up, is that I've pinned the gain at 49.50. But again, it didn't matter in this case because you're getting, if you bought to close the 49.50 to cancel the obligation, you're getting 53 regardless, so it doesn't matter. Okay. Oh no, did I just do that? Tell me I didn't. No, I didn't. Okay. Frank's question. Now that we've talked about this obligation and some of the risks, I know it's a little bit confusing, but remember, and it's always key to remember, it's something I emphasize a lot, whether we're talking about credit spreads, iron condors, the radioactive trades here with the protective positions, always remember, whenever you're looking at a fancy profit and loss chart and saying, ooh, I'm bulletproof, there's no way I can lose, let me sell this and do this, always remember your obligations. When you sell a call, you may end up delivering shares of stock or being short stock. When you buy a put, you're protecting positions, but you may end up being short stock if you don't own stock anytime you buy a put. If you sell a put in a bull put credit spread, remember, if it ends between the strikes, you may end up buying shares of stock. And that's another disadvantage of the credit spreads we didn't talk about in that earlier conversation. We were talking about our bull puts, and this goes into Frank's question coming up a little bit. We were talking about bull puts and bull calls, where we were selling the 244, for example. No, it was 241. ETF SPY was at 244. So we were selling the 241 and buying the 236. Now remember, in a bull put credit spread, if the stock dropped down to 239, this put is 2 points in the money. You may end up buying 100, 500, or 1,000 shares of SPY at 241 if you didn't close it out because it's between the strike prices. On the bull call side, if it's below 241, the call just expires worthless, and the call still has, your 236 call still has $3 of intrinsic value, so you don't end up with that risk. Well, no, you do. Sorry. If you don't close out the bull call, the 236 is in the money, the 241 expires, so you would end up being long 100, 500, or 1,000 shares of stock at 236 if you don't close it beforehand. So one, the short put would cause you to buy stock. The other, the long call would cause you to buy stock if you don't close it out ahead of time, which is a good point. When both are in the money on the bull call, it's okay because your broker buys them for you at 236. They assume that's what you wanted to do with the in the money call, and then they sell them for you at 241. That's great. But when it's between the strike prices, you may be long X amount of shares at this price. Of course, you don't have the capital to cover it. That's going to be a problem. Okay, so going into Frank's question, I just saw it come in. It says, what I don't understand is there is 12 or more traders on the internet selling the benefits of credit spreads. Would doing the exact opposite, a deep in the money debit spread, have the same probability of success for less risk? No, I'm sorry, this is what we talked about earlier, Frank, that you might have missed. They're parity, in most cases, they're what's called parity trades. When we looked at the combination of them, we looked at SPY, for example, the credit spread was giving us a much better return than the parity debit spread. But you're right. They have the same exact probability, same exact max return happens if X and max loss happens if Y. That's what a parity trade is. Same probability. It's not less risk. The moneyness is essentially the same. Let's take OKE. I don't know this position. I don't know this security. Let's just go to June. I want to open a reasonable, out-of-the-money, Frank, bull put credit spread with the stock at $49.55 for 14 days out. Let's keep the math simple. I'm going to sell a 48, $1.50 out of the money for 35 cents. And I'm going to buy a 46 for 10 cents. I know it's not a great net credit, but we'll just use this as an example. Okay, so 48, 46, 35 by 10. So we're going to sell our 48, buy this for 35 cents, and we're going to buy the 46 for 10. We get a 25-cent net credit on 2-point spread, good double-digit percentage return, as long as the stock stays below, as long as the stock stays above 48. Both puts expire worthless. We keep the net credit. We make a 14.3% return. Your broker may charge you $2 to cover the position, but they also may charge you $1.75. Okay? And what we talked about earlier, all right, Sam had a comment that says selling goes against the stock. Oh yeah, Sam was just talking about selling calls regardless of doing it in that fashion, regardless of doing it with the other one where we saw that check mark because we had the long call to leave it open. I just want to remind everyone that, look, selling calls, and I agree with him, selling calls on a long stock is a bearish position. It's a bet that the stock's going to stable or move down. You don't want to sell a call if you think the stock's going to move up or it's in a strong bullish move, okay? And Sam's preference, and I haven't finished this discussion yet, but Sam's preference is to do the bull put credit spreads 2 to 3 times weekly. But anyway, let's go back to Frank's discussion. Why don't people talk about debit spreads? It's the nature of an investor, Frank. But let's look at it this way. So what would happen here? I have a 2-point spread. My monetary requirement is 2 points, but my broker may only require this max loss of 175 because I took in the net credit of 25 cents. Okay? So what's going to happen on our bull put? I have to put up 175 of margin requirement to cover the difference in strikes. This 25 cents is deposited directly into my account. I don't want to use the term sexy, but this is why most investors find this sexy, because you see the money coming in right away. You can actually use that to trade into another position. We're generating premium, which, generating premium means I've lowered my break even though I've sold the 48 strike put. I've lowered my break-even to 47.75. Yeah, well, you did, but you didn't you lowered it because of the structure of the trade, not necessarily because you collected a credit. Now, same position. I'm sorry, OKE, lost my pen. OKE 48.46, bull put spread, 25-cent net credit on a 2-point spread or 175 risk. We know the max risk is 175, credit's 25. That's a 14.3% return. Let's ignore what the probability actually is and assume that this was a 72% probability for a 14-day trade. Now, closing prices, real. Let's go to June 16th. Why wouldn't I do the 48, 46 debit? Okay, so here we've got a 50-cent strike difference. I'm sorry, bid-ask spread is 50 cents. So let's do 25 cents. So we're going to sell the just slightly in the money 48 call for 210. On the 46 call, we've got an 80-cent bid-ask spread, 350 to 430. So this is going to put us at 390, 40-cent midpoint. Okay, so we're going to sell for 210, buy for 390. That's our midpoint prices on our 2-point spread. Oh, I already added them. Added it again. Okay. So remember, we're selling just as we sold the 48 put. We're selling the 48 call. We're going to get 210 for this in-the-money call. And we're going to buy the deeper in the money 2 points more for 390. Okay, so what does that mean? Well, now we've got a debit of 180. If the stock stays above the strike price of our position, then we hold it through expiration. We'd buy shares of stock at 46, sell them at 48, we get 2 points back. So in this case, we get a 20-cent maximum profit, or 11.1%. Again, in this situation, we see the credit spread has a higher return. But that's not always the case. Let's say you got a little bit better pricing. Let's say we sold this for 215, we got this at 385. Now I've got a risk of 170, and if everything works out as I want, the stock stays above 48, we close the position out, get our 2 points back, and make 30 cents, or 17.6% yield, a 30 cents over 170, versus the bear call that had 25-cent maximum profit over 175. Same exact probability. The stock would be above 48. But it's a 17.6 versus a 14.3. So why do the credit spread? Why are so many gurus, as you mentioned, out there, coaches, talking about credit spreads and not debit spreads? It's because it's easier to sell. I apologize. It's easier to sell. People want to see money coming in. Frank, you know, and I don't remember, I think it didn't appeal to you too much, one of the strategies I do, the radioactive trades, where I'm buying stock and buying a put option to start. And it's 6 to 7 months out in time. I know you know it. You and I have talked about pros and cons in other webinars and so forth. But it's a position I can enter on a stock that guarantees I can't lose more than 5 or 6%. It's not for everyone. But when you look at it and you say, well, let me go back. I have a lot of people that come in when I talk about the married put, and they say, well, why doesn't everyone trade like this, where they're guaranteeing you can't lose more than 5 or 6%, and you've got unlimited upside, as opposed to what you have with a covered call, where you buy the stock and you sell a call for a 2% gain, which means you're still risking 98% of owning the stock outright. How is this touted as advisors and at brokers as a conservative strategy? When you're still risking 90%, 98% of what you invested, but you're making 2%. I don't know. Level 1 trading allows investors to do covered calls who've never traded options before. I think it's opposite. I think level 1 trading should allow you to do married puts first. So you guarantee you can't lose this money and you leave your upside open, instead of capping your gain and still taking 98% risk. This is not a conservative strategy, in my opinion. Especially as Sam mentioned, we're in a bullish trend. Selling a call might be the last thing I want to do. Sure, I made my 2% return, but I might have missed out on 4 or 5 other percent. I'd rather see investors do this. Okay. And it's not for everyone. I get that. I understand why married puts don't appeal to people, but it's a battle I fight because it's what I trade. And of course, working for PowerOptions and radioactive trading, I have to teach people the benefits of doing this. But what I'm saying is that occasionally I get a customer who says, why doesn't everyone teach this? It's because it's not sexy. No one wants to be told to buy stock, and rather than lower the cost basis by selling a call, which caps your gain and still takes on 98% of the risk, no one wants to hear about putting more money into a position to cover losses to only 5 or 6% because it's not attractive. You want to generate premium. You've been taught, and it's attractive to generate premium, see money coming in. It's like renting out your house. You're seeing money coming in and lowering your cost basis. There are other brief factors we talked about in comparison of the bull put to the bull call debit, but in general, most people teach the bull put credit because it's sexy. You're only putting up 175 to make 25. It's a 14.3% return for 14 days, and you see money coming in right away. Now, they're not going to show you the one big thing. What do they teach you, Frank? What are you being taught with these 12 people who are teaching credit spreads, which I don't agree with, by the way, because there are flaws in it? What are they teaching you? They're teaching you that you can get double-digit returns for a 1 to 2 week out trade, having a 75 or even 80% probability of success. And you get money coming in with a credit right away. That's, in theory, the home run when you think about everything else. You don't want to buy calls because you know that you could lose 100% of what you invest. But if you do a credit spread, you get this premium up front. You're only risking a small margin, the difference in strike prices, and you've got an 80% probability. What is this here between 25 and 175? If we look at that, isn't that essentially an 8-to-1 risk-reward ratio? You're risking 8 times what you can potentially profit. Now, it's the same with a debit spread, don't get me wrong, but this is an 8-to-1 risk-reward ratio. When you have an 8-to-1 risk-reward ratio, you actually need to be right about 90% of the time to profit long-term, not 80. That's the issue with the vertical spreads. But why do more people sell the credit spreads? Because they're sexy. Money up front. Low risk. Credit. High probability. Is it any different than the debit spread? Not really. The only difference is, remember, when I trade a bull put, if I sell this 48 put, buy the 46, and the stock stays above 48 in 14 days, both options expire worthless. I keep the net credit. On the debit spread that we're looking at here with a cost of 170 to make 30, in order to get this $2 back to realize this 30, I have to either sell to close the 46 and buy to close the 48 before expiration, or leave it alone and have my broker buy shares of stock at 46 and immediately sell them at 48, which might result in 2 more commissions. Okay, and I had to pay up front. And people say, oh, you could lose 170, you could lose that whole debit or 100% of what you paid. The credit spread's the same. If it falls below 46, you're going to lose the 175 you put up in the position. Okay, and never, Frank, ever trust someone out there who's selling credit spreads. Okay, never trust someone out there who's selling credit spreads and says that, oh, well, the spread expired worthless, we kept the 25 cents, we made 100% on the trade. No, you did not make 100% on the trade. You made 100% on what you expected to make, which was 25 cents. You didn't have a credit spread that earned 100%. It earned 14%. You earned 100% of what you expected to make. But that's like saying I did a covered call where I bought the stock at $49.55, sold the 50 call, the stock moved up and I got assigned for 3%, but you know what? I made 100% on my covered call. No, I didn't. Yeah, I made 100% of the 3% I expected to make. This credit spread made 100% of the 14 because this risk is still there. It is still there, and if you take one max loss, that could wipe out 8 or 9 previous trades. But I see people trade this, say, oh, we've made 100% in our last 10 credit spreads. No, you didn't. You made 10% of the risk. You made 11% of the risk. You did not make... seriously, there is a guy out there who teaches credit spreads, and he touts himself as an 80%, 85% probability, or 85% winnings of his closed positions, not the ones he had to roll out in time. But he touts 85% or so, 87% of successful trades that expired, that he closed, that he allowed to expire. Because, yeah, they expired out of the money. He rolled the other ones. But anyway, he says he makes 100% on the credit spreads with an 87% success rate. It is not 100%. It is not. You made 100% of what you expected to make, which was 8, 9, 12, 14% of the credit and the risk. Yeah, and Sam says, the risk is 1 to 9 on spreads to get those kind of credits. You're absolutely right. And it just, I can't believe he still gets away with saying he makes 100% profit on spread trades. It just boggles my mind, okay? And Sam also mentioned sometimes greed comes in. That's when you get hit badly. Yeah, when you see the higher returns, a higher volatility, you're going to do that. And Sam's been doing bull puts on Tesla. He's never sold the call. And of course, just as we were talking about, Frank, just remember your obligations in either situation. If I did the bull put here and the stock ended between the strikes and I didn't close it, I have to buy shares of stock at 48. But on the bull call, if the stock ends between the strike, this call expires and I'm buying shares at 46. So in both situations, if it ends between the strike, if you're in a bull put, you'll buy shares of stock at the higher strike to fulfill the obligation of the short put. In the bull call debit spread, you'll be buying at the in-the-money call at 46 if you don't close it beforehand. So either way, you might end up owning stock. Real quick, I'm going to take these numbers. I'm going to do something very quickly. And if you have any last-minute questions, send them in because it is 5:45 p.m. Eastern Time. I'm going to go to radioactive trading. And I'm going to go to, sorry folks, yeah, I'm going to go to the resources tab. We're going to go to the trade simulator, which I always like to bring up. Let's take our numbers, okay? Let's take that spread position where we were on the bull put, we were looking to make 14.3%. Now, our maximum loss, 25 cents, our maximum loss was 175 with that 25-cent net credit. And that came out to 14.3. So a 25-cent net credit against a risk of 175 for a 2-point spread, remember. That's what we're looking for, okay? So what does that mean? Well, that means if the spread goes against me, I can lose 175. It's an 8-to-1 risk-reward ratio we talked about. But let's change this a little bit. Let's say I never allowed myself to take the maximum loss, that I even only took a loss of 50% of this, okay? 50% of the maximum loss in a trading record. So I'd close it out if it got to 85 cents or so. But I'm doing credit spreads with an 80% probability. So I only have a 20% probability of loss. Now let's take a $10,000 account and let's put in 33%. So what does that mean? On a 2-point spread for a $10,000 account, we're only going to allocate $3,300 to each trade. Now let's do 25. Okay, let's do 25. Okay, so that means that we're only going to allocate 25% into each trade. 25 of $10,000. So we'll have 4 trades open, both around, all around $2,500 for the 2-point spread, or 175. Okay, so we're looking at maybe 12 contracts or 15 contracts. Now here we see that if we have 83 winners, 83% of the time, our 80% probability, 83% of the time we win, we only lose 17% of the time. At one point, we took the $10,000 after 100 random trades. We might have dropped it down to a 32% loss, $6,800, but we almost doubled our money. Okay. But see here, 80% probability, 20% probability loss means you need to be right. If you're right, even just 78% of the time, you end up long-term with a loss over time because it has to be above 80. Let me try to get right to 80. Okay, so in this one, 80-20, it did break even. It got a little bit of a gain here, okay? But you needed to be right exactly 80% of the time. Most positions I see, by the way, we're generous with the 14.3% because that was our example. Most spreads I see, let's say with an 80% probability, are looking at 20-cent credit on a 2-point spread, 50-cent credit on a 5-point spread, which comes out to 11.1% return. Even with an 80% probability, you see here that with only that 11.1% return, limiting loss to 50, 80 wins and 20 losses, you're behind the 8 ball. That's why I say that with the standard one, when I look for good stocks, not as volatile as maybe OKE or have that good premium, an 80% probability spread is usually around a return of 11 to 12%, not 14 or 15. I still am only going to put in stop orders to only risk 50% of that 2-point spread or that 5-point spread. If it starts moving against me, that's going to be my trigger. I'm still going to expect to be right 80% of the time. But we saw here 83% winners looking for an 80% probability were just a small profit. So typically when you see those numbers with an 80% probability, you actually need to be right more than 80% of the time in order to profit long term. There we are at 82. Here's 85. Okay, so we get 85% winners. We see the returns we're expecting, 30% winners over the course of the year. Can't be right 80% of the time. Need to be right 85% of the time. So at any time, go to radioactivetrading.com, click on the Resources tab at radioactivetrading.com and go to the Trade Simulator. Run sort of your risk-reward tolerances, your target goals for your returns, your loss limit, your probability of loss, okay, and how much you'd invest per trade, and see how this pans out, and you can add commissions as well. This might answer why you feel you're not getting ahead doing credit spreads. But back to square one, Frank, that's why I feel that investors that you see out there who tout the spread positions, which are very risky, you know, one loss is going to wipe out 8 or 10 previous gains. You've got to be very careful and know your technicals and know your fundamentals to pick good wins. But that's why they typically show, in my opinion, show the credit spreads, because it's sexier to see credits coming in. You still take the same risk. It is still a parity trade. You're right on the ball there, Frank. You have the exact probability on the parity trade bull call debit spread using the same strikes. One pays a debit to get in versus receiving a credit. With a debit spread, you might have to pay extra commissions to close it that you don't have to pay on the credit spread if it works out. In both situations, you may end up owning stock if it ends between the strike prices. In the bull put, you'd be put the stock. On the bull call, if you didn't close it, you've got an in-the-money 46 call. Your broker would assume that you want to buy the stock at expiration. Okay? All right. Well, ladies and gentlemen, that looks like the last of the questions that have come in. I apologize here. So it's about, again, 5:45. Let me just scroll through here. Sam does have another comment. There you go. But what I wanted to go through here is, you know, just, of course, those of you that are new, that you haven't started it yet, remember you can take a 14-day free trial at any time. Just go to PowerOp.com, put in your first name, last name, and email address, and you'll take a 14-day free trial to the service without needing any credit card information or anything beyond that as well. And of course, after that, the subscription levels, we do have an end-of-day service, which is only $40 per month. Most popular is our 20-minute delayed service, has access to all the search tools and analysis tools. With 20-minute delayed quotes, it's $60 per month. We do offer a real-time, and we do offer historical back testing services for the search and the search by symbol tool and the option chain, historical chains, which go back to April 2006. You can add that on to the 20-minute delayed service for an additional $40, to be $100 per month. And then the premium service offers all real-time access to the programmer's interface, the API, and the historical, and that's $160 as well. Other free stuff you can check out, go to blog.powerop.com to see some of Ernie's articles and some of my own on different options, concepts, strategies, and more. Remember, you can take a look at any of our archived webinars at any time. Just go to powerop.com/webinars.asp. We have a variety of different webinars there on the Power Options tools, options strategies, our Friday discussions. And remember, you can go to YouTube at any time, look up Power Options and see some of those is there. Sam's last comment, I'm sorry, was when a stock has a problem like Apple, after a Qualcomm case, Apple was going lower. That's the time one could sell the 155 calls. Yeah, he's talking again about the selling the calls on the stock and so forth, doing it for protection as well as that. And Frank says he's been doing credit spreads on weekly SPX contracts. Profit is 66% for 4.5 years, I guess he's been saying. So he's been doing that. Frank, that's great. You know, good job on the weekly calls there, or weekly spreads, I'm sorry, on SPX or on SPY. You're doing really good. That's a really good return there. I'm very happy for you. And some investors do it, and some investors call me up and said, yeah, I was promised, I took a course where I was told I could have 80% winners or 90% winners trading out of the money credit spreads for double-digit returns. I've made 4 trades and my account's down 20%. Can you explain what's going on? So, yeah, they didn't address the risk with you properly. That's what's going on. Or you picked a bad market, you know, and not everyone wins it. And sometimes if you stick with it, you can pull out of that. But if you get 2 or 3 losses right off the bat, you've probably taken 50 to 60% of the trading funds you allocated to cred spreads already out. Oh, and it's only 15% per year. Yeah, no, that's still good though. 15% per year, Frank, is actually, with your credit spreads, 15% is doing a little bit better than, well, actually it's a factor of 5 better, but it's doing better than I average with my radioactive trades, and a couple percentage points better than I average on my portfolio with the combined married puts, calendar spreads, some credit spreads on SPX. I trade maybe 1 or 2 a month. Really, it's come down to about 1 every 2 months I've been doing in my portfolio on SPX, and I've been doing these weekly long straddles on earnings, which have been doing really good the past couple weeks. Okay. So yeah, Sam says 15% is very good returns. Yeah, that's what Ernie and I shoot for, is above 10, 11% there on those positions, and per year, and that's 15% is really good. I think you're outperforming most investors, Frank, even though those ones that tout, oh, you could make 60% per year or 300% per year buying calls. I don't know anyone who's actually achieving that consistently. You're doing really good. Consistent returns, averaging 15% per year, that's fantastic, I think. I really do. It's beating me, so I can't complain. You should come teach one of the webinars, Frank. All right. All right, ladies and gentlemen, yeah, just a reminder, of course, if you think of any other questions later on this weekend or during next week, remember, send me an email at any time to support@powerop.com. And of course, you can also email me to support@radioactivetrading.com or call the office during market hours at 302-992-7971. And of course, those of you on your trials or subscription, remember, you can schedule a coaching session at any time to talk with Ernie or talk with myself. And Sam says you're crushing it there, Frank. You're crushing it with that 15% return. I agree with him. You're doing extremely well. Ladies and gentlemen, thank you again for joining me on this Friday afternoon. Have a fantastic weekend, and we'll see you next week as we go back into trading into the next week of going into June 9th expiration and getting 1 week closer to standard June expiration. Take care, everyone. Good night.